First of all, thank you very much for inviting us here. Happy to have the opportunity to talk about the context, about what the current situation creates in terms of opportunities for local economy, for mainly. I would like to have, I have few slides here. I would not go necessarily through all of them. I would just like to take a look at the big picture, first of all. And I think that the main trend we are seeing in the last years, it's a trend out of the globalization we've seen till probably 5-6 years ago. And we are moving towards some kind of regionalization. And I extracted here some headlines from media. On the top, you see The Economist 2019 saying globalization is dead and we need to invent a new world order. Again, in 2020, looking for the killer, was COVID the one who killed the globalization? Moving forward to the current year, 2023, the destructive new logic of that threatens globalization. Moving down, we see Reuters and IMF talking about the impact of deglobalization in terms of cost for the global economy, because of course, less globalization, less commerce, that means inefficiencies and probably drives to the current context of high inflation we are seeing. Of course, a more positive headline also from Reuters talking about the trade boom who's still keeping globalization up. But if we are looking to this slide showing the global trade to GDP, we see that after the move upwards till 2013, 2014, we see a slight decline in the coming years. So overall, I think that this is the world we are heading in. I think that looking on the long run, of course, we are living in a small village, and of course, we are going to trend towards a more global world. But I think that at least for the foreseeable future, we are going to be forced to think a little bit more regional. And of course, we are asking ourselves, what does that mean for us? And of course, we are looking at Romania. We are looking at Romania in the European context. I'm looking at the Bucharest Stock Exchange in the local context. I'm looking at the banking sector. And I would extract from my thinking the positive side. I think that what we have seen, at least in the last years, it was growth of local bias, I would say. We saw the crisis in the last 15 years. We saw the financial crisis back in 2007, 2008. We saw the sovereign debt crisis, which hit mostly the countries from Southern Europe. Sorry. We saw the COVID crisis, which is supposed to have been the killer of the globalization. We saw the disruptions at the level of the global logistic channels. We are now seeing the war in Ukraine, and we see that all these things are forcing us to think a bit more locally. Looking at the stock exchange, I have to say that I see this trend. We see in the last 2-3 years more local companies coming to the stock exchange, financing themselves, trying to position themselves in the connection with the local market. So I take it as a positive for the local environment. I think that this is also supportive and positive for the banking sector, because of course Omer is going to talk about the upside of the low level of financial intermediation and of the upside we have here. And I would say that in order to grow the financial intermediation, if we look at the financial intermediation as, for example, loans to GDP, I think that first of all, we have to have better access to capital for the local companies. So we see that happening. We see that, more companies are looking at the stock exchange and at the local investors in order to fund their growth. I think that this is going to be supportive, and this is supportive for the local banking sector. I think that this trend is going to continue, and I would say that at the end of the day is going to be positive also for the European construction, because a strong Europe needs strong components. A strong Romania, for example, is not going into a conflict with a stronger Europe. Strong Europe needs stronger component countries. So I would take the positive side out of the picture we are seeing now around us. That would be all for the moment. Thank you.